Hey, welcome everyone here to our Forecasting Made Simple webinar. We are going to give a couple more minutes for people to join us here before we get started. You should be able to hear me at this point. If you don't hear me, use the chat box and let me know so we can have a good webinar that's not silent. So we're going to wait a couple more minutes and then we will get started here. Thanks. All right, well, again, welcome to our Forecasting Made Simple webinar. We're glad for you all to attend. We're going to spend, the next, 30 to 45 minutes talking through what forecasting is, how we can use it for our businesses, as well as, how to make it, simple and useful, and not make it a complex thing that ends up getting ignored. Couple housekeeping items here. We are going to have some time at the end for questions. There's a chat box here. If you have questions, though, throughout the presentation, feel free to put them in the chat box, and we can answer those. And if you want to see this again, we are recording this, and this will be on our YouTube channel, as well as we'll put the link in our website, and as well as on social media. So we're going to go ahead and get started here. Just a little about us. We are Lance CPA Group. We're a certified public accounting firm built to help small business owners and entrepreneurs grow and manage their businesses. We want you guys to consider us a stakeholder and whose number one interest is helping you guys succeed and making your life easier along the way. You can find us at lancecpa.com. My name is Josh Lance. You can get me directly at josh@lancecpa.com. Feel free to shoot me let's with questions or things relating to this or any other accounting topics that you have. Let's go ahead and Next slide here. So here's our agenda of what we're going to be talking about. We're going to talk about what is forecasting. What are the objectives of forecasting? So, I think there's a lot of confusion on why we do forecasting and what goes on and what's the purpose behind it. So really I'm going to talk through those things and understand what a forecast actually is and does, and then talk about the things that we can make forecasting simple. We like to use forecasting with our clients. I know a lot of businesses don't really understand what forecasting is or how to use it effectively in managing their business over time. And that's really kind of our goal here for our presentation. So what is forecasting? That is, a question we get. There's kind of a lack of understanding of what that is. So our definition, our kind of textbook definition of this is a forecast is the latest expectation of what is going to happen in the future based on past results. So we are taking the information we have about our business, what has occurred to date, and using that as a jumping point or launching pad to talk about what is going to happen in the future. Really the forecasting answers the question of what do we expect to happen in the future based on where we're at today. So we are not using forecasting to, guess on things that aren't really applicable to where our business stands. It has to be realistic to where we are today, where we expect the business to go, and have really the underlying assumptions that make sense of where our business is going. A bad forecast would expect, if we said, hey, we're going to, currently our company makes $10,000 a month, and we expect next month to make $200,000. Well, if there's no real basis beyond that, that's not really a good forecast. That really doesn't answer the question of what we expect to happen. We may want to make that happen, but that's not reality. And so forecasts can also provide different scenarios. So it's not just a forecast provides what goes on, but we can have different scenarios built into those forecasts and say, well, what happens if things are really good and we expect income to increase by 20%, or what happens if things are bad and income goes down by 10%. We can do different scenarios and see what the results of that are, and ultimately those results are kind of help us get that data and information we need to make better business decisions for our company. And forecasts are continually evolve. It's not something you put together at one point in time and stick with it and never change. It's something that evolves as the business evolves. So as business and the historical things that have happened occur, we're able to use that information to adjust our forecasts accordingly to, again, provide better information for us. Now, there can be some confusion between what forecasting is and what budgeting is. There is, kind of the old school budgeting, things that companies went through was that at the beginning or at the end of a year, they went and put in the smallest time, put together a budget for the next year, and they laid it out, and then it was kind of a static document that never really changed and sometimes never was looked at again once it was approved, right? Some of that is evolving in the budgeting sense. And is getting more close to what forecasting is, and so you're tending to see now those things kind of combine. But there are some distinct differences between those two. So kind of the textbook definition of budget is the financial expression of your target and the intention of where you're going in the future. So that kind of sounds similar to what forecasting was, but it's a little different. We're looking at where we think we're going to be in 12 months and putting a target there, a goal there, and that's kind of what the budget does. Whereas the forecast is a little different. So a way to think about this is with driving a car, right? So if running your business without a budget is like getting your car and driving with no idea where you're going or where you want to go. So that's you jumping in your car and just driving aimlessly. There's no real idea of where we're going. You're not plugging anything into your Google Maps or into your GPS that says, hey, I want to go here. It's just mindless driving. So with the budget, we would say, hey, I want to get to this point in the future. So like driving a car would be, I want to go from Chicago to Milwaukee. I know where I want to go. I have my end goal and point in mind. And that's really what a budget is. We're trying to get to like, where are we going to be at a certain point? Where we want our business to go. You know, with forecast, it's kind of like, you know, if you're driving a car and you put a blanket over the car windshield, you can't see where you're going or what's in front of you. The forecast really kind of helps you kind of see where, you know, my goal is, you know, to increase, you know, revenue by 15%, you know, in 12 months. How am I going to get to that goal? And that forecast really helps drive us to how we get there. So ultimately, in an organization, your forecast and your budget needs to be aligned. If it's not aligned, then we have basically two competing methodologies or two competing ways of managing business that aren't syncing together. Ultimately, our forecast, you know, should be able to drive us to that end goal. If we do our forecast correctly and we're not getting to that goal that we set in our budgeting, that kind of tells us that, you know, maybe either our budget was inaccurate or our forecast is not accurate as well, right? So they kind of play with each other. And like I said, there's a lot of companies now are kind of combining these two together and saying, you know, really my budget and my forecast are becoming one and the same instead of being these two distinct processes. So when is forecasting done? You know, a lot of times when people encounter forecasting in business, it's their first step or first part of that is with a business plan. So they create their business plan, they write about what their business is and what's going to happen. And there's always this, you know, section about financials, and it's just kind of this pro forma projections of this is what we expect to happen in 3 years for a business, and they lay it all out. And it's this great document, and it's put in the business plan, and then business starts, and that business plan gets tossed aside, and the forecast never gets looked at again. You know, so this is where it's typically done, which is it's a good thing to do as part of your business plan, but a lot of companies then just kind of set that aside and forget about that and don't continue to use it. You know, another place is in the bank loan. So you need to get a loan for working capital or for equipment. You know, with our breweries, it's a lot of, you know, we need to get a loan to expand the brew house, buy more fermenters. You know, so forecasts are needed there as well, and banks will ask for that, and then we'll say, hey, I need, you know, give us a forecast for the next 3 years so we can see, you know, is this going to make sense to give you a loan? You know, what happens when we give you this loan? How does things change? So that's typically when the forecast can be done. Or if you have investors or looking to get investors, investors will want to know, yeah, that's great what your current financials are, but what happens when you put money into the company? What's that going to change? So investors, you know, will want to see forecasts, and, you know, those are typically done with that part or as part of a prospectus or other, you know, pitch decks or things like that. Sometimes it's a compliance exercise. You know, our company, we expect to do forecasts every year, so we go through the hassle of doing it, but it's not something that is living and breathing. It's done once a year. It's, you know, put it in front of a board of directors, and then it's not seen from again. And again, expansion kind of goes hand in hand with the bank loan. But really, when should forecasting be done? It should be a exercise that's done all the time. You know, if we really want to have a forecast to be meaningful for a company, we really want that information to be useful to help us make decisions. This is something that should be happening all the time. So building a forecast and maintaining that forecast and comparing it to actuals, and then, you know, continue to, you know, further add forecast information, you know, as the time goes on. So our forecast continues to look in the future, and we, you know, and adjust for, you know, the actualities of the business as actual information now occurs that we compare it to. You know, it should be an exercise that's done all the time. Now, a lot of businesses won't go through this because it's you know, something they don't understand, or it's too time intensive, or things like that. And it's not something that is done as a regular exercise in the business, which we think in our firm it's a good thing to do, and it's really useful and helpful. So let's talk a little bit about the objectives of forecasting. So what we're trying to get out of a forecast, what, you know, we're going to put together this forecast for the business. What are we trying to learn from that? Because ultimately that's what it, you know, that's what we should begin at, looking at kind of the end in mind here. Our kind of objective is to see where is the business going, and based on the information we have for us, where is it going? What are we going to do with that information? And then make decisions on that. So if we put together a forecast and we look at it, and it shows that, boy, we're going to run out of cash in 6 months. That lets us know now we need to make some changes or find additional financing sources or look to investors or things like that. We don't want to wait until that happens and run into an issue. We worked with businesses where that's been the case, where they didn't put together a forecast. They weren't really looking out in the future, and then it came to the point where, oh, geez, we're running out of money, and we're scrambling to find loans or investors or things like that. And then we're always kind of behind the 8 ball. We're not really looking forward to where the business is going, or we're trying to account for past errors of management. So really doing this allows us to avoid those unforced errors. If we see a problem upcoming, we can deal with it now versus waiting for that problem to hit us and then not having the time or the resources to do something about that. We can analyze the impacts of certain decisions. So let's get to a scenario. So if we decide, hey, we want to grow our business, and we're going to, by doing this, we're going to hire a salesperson, and we expect the salesperson to bring in X amount of sales, but they have so much cost associated with it. What does this look like for a business? Or if we're going to expand our brewery and we know we need to get 4 more fermenters or a bigger brew house, what does that look like for a business? We can do different scenarios and put together different assumptions and see how that plays out. Knowing what we know and the things that are currently going on in our business, and making those changes and add them into that forecast scenario, we can kind of see what that means for us. Sometimes you may think, oh, we really need some more staff than we're going to hire, but that hiring of staff, may result in less profitability or some other things we weren't expecting. So to put that information in there allows us to make those decisions, and doing different scenarios allows us to see how those decisions play out. A big one here is understanding cash flows. Where is our cash going to be? Do we run into issues of running out of cash? So kind of 2 metrics that kind of go along with our forecast are our runway and our burn rate. Our burn rate is how much cash we're burning each month. So particularly in a business that is not profitable yet, this really allows us to see, okay, well, if we're burning $20,000 a month, how much cash are we going to have left here after 6 months, or where's that going to put us in a cash flows here in the future? And the runway is how much time we have until we run out of cash. So that's really critical in startups or early stage companies, that are particularly relying on investors for cash, or relying on, meeting certain sales goals to have enough cash to continue on the next day. So looking at a runway and a burn rate allows us to kind of see, okay, well, are we going to have cash flow issues in the future? Do we need to get that working capital line of credit now? Or in the flip side, we're doing so well that we're building up this nice cash cushion. Now maybe we know we have enough money to go out and make that equipment purchase or expand our business in a certain way that allows us to do that and know that we have the cash resources available to pay that out of operations versus having to go get a loan or bring in additional investors. And again, attain finance and investment is a way for us to see not only do we need to bring in that extra cash, but what that extra cash does for us. So it's not necessarily we're going to run out of cash, we need to get some finance and investment. But if we are thinking, we really want to grow our company, and this involves a huge, capital investment or a huge cash outlay, how much finance investment do we need? Do we need to, get loans, and how much loans do we get? Do we have enough money from operations to help subsidize any additional financial investment? And kind of back with that too, part of the whole forecast, and particularly if where our burning through cash is trying to see when that time is. And we'll talk a little bit about, some making forecasting simple. But one thing we see that always raises a red flag for us when we look at someone's forecast is, there's that month where they run out of cash and magically they get that investor that comes in, or that loan magically comes through that same month to provide them enough cash to keep on going. And so when we're building forecasts, we want to avoid having that magic financing fairy or magic investment fairy show up that comes just in that right month. We need that cash. If you're a bank or if you're an investor, that looks a little suspicious, because that begs the question, well, what if that cash comes 1 month later? Right? You're not going to be around that next month to receive that investment. So this kind of allows us to plan ahead of time and say, well, if we know we need finance in 6 months down the line or a year from now, we can start doing the things we need to do now so that we bring in the cash well ahead of that time where we run out of cash. But ultimately, this gives us a complete view of the business. This allows us, to see the business in totality. A lot of times we rely on our profit and loss statement to kind of see how our business is doing, but that's really a historical look back. Well, that's good information for us. It tells us what we did. It doesn't tell us where we're going. And this kind of gives us the future focus that we need for a business versus just having a historical focus. We want to have that complete view. We want to know what's behind us and what's in front of us. And without having that forecast in place, it's kind of, what's in front of us, it becomes more of a guess versus having a path forward for us. Now, really, forecasting allows us to run the business better. It gives us better information. It allows us to use that information to make actionable decisions. So it really allows us to run our business better and be on top of things, and not falling into traps where we're fighting past battles and we're not, moving ahead. We've worked with some companies that, have struggled with this, and they're constantly fighting the battle of things that happened 6 months ago. And they're always looking in the rearview mirror and they're not looking forward. And it's not a good way to run the business. So having forecasts in place allows us to run our business a lot better, makes better decisions for us. So understand a forecast. So what is a forecast? What does it mean? How can we understand it? I think this really was some of our impetus in doing this presentation. We see a lot of different forecasts that people make or have outside companies make for them, and they tend to be super complex. And while that is all well and good for us because we can understand that stuff, for the business owner, if they don't understand this really complex spreadsheet with multiple tabs and what are all the inputs and where are the calculations being made, it becomes really hard to understand what the forecast is doing. And then ultimately it's harder to use that to help the business. So part of this is help us understand what a forecast does for us. And then when we go to build it for our businesses, we want to do it in a way that's simple and straightforward. So the elements that make up a forecast. One is historical financial data. So what has happened in the past? Now, if we're a new business or a startup, we don't have that. We don't have that to lean on. But for businesses that do have historical activity, we want to use that information. Like I said before, we're not magically going to go 1 month to have 10,000 in sales and the next month have 1 million in sales. That's not realistic. We want to have that historical data that says, okay, well, for 10,000 last month, maybe this next month will be 11,000. But that now gives us some basis or something to anchor ourselves into versus just throwing a bunch of numbers out there. Industry benchmarks is another element that makes this up. So how are other businesses growing or doing, or how's the industry faring as a whole? We recently just did a forecast for one of our brewery clients. And part of our kind of forecast and looking forward, and that is, well, how has the industry performed, particularly at their size of brewery in the past, and where's expected to go? If our kind of forecast of revenue or forecast expenses aren't in line with what the industry is doing, we better have a really good reason for that, or otherwise our forecasts don't really make sense. So we want to use those industry benchmarks to help us to drive that. And all that information is available online. There's a lot of statistical data and information that's provided. or if you have access to like an IBIS World or subscriptions like that that provide these specific industry guides, those are good as well. External data, so beyond the industry itself, you want to take that external data of what's going on in the economy as a whole and apply it here too, right? So if we're heading into a big recession, we're not magically going to, our business is not magically the one that kind of springs out of that and is doing the opposite of what's going on as an economy as a whole. So we have to keep those kind of more macroeconomic expectations and things that are going on in mind, because those are going to have an impact on our business. Now, they may not be as, depending on what our business does, we may be somewhat immune to that, or they may not have as big of an impact, but we still have to consider that in our models. And then the biggest thing that makes them forecast is assumptions. And I think this is an area that's a little trickier to work through, because ultimately a forecast, we're going to be making some educated guesses as to where we're going. But we have to have something that backs up those educated guesses. If we say our revenue is going to increase by 20% year over year, there's got to be a reason behind that, other than that's just what we think or that's what we hope. We need to have some data and information. Then this gets back to some benchmarks and historical financial data and external data, but using all that data to make an assumption that says, okay, this is what's going to happen in the future. And this goes along the line for your revenue, your cost of goods sold, or cost of services, and expenses you have. That all plays into it. And particularly if you're looking for outside investment or a bank loan or things like that, those parties are going to look heavily on your assumptions. Because if your assumptions aren't grounded in anything or aren't anchored in anything, then the data that you're giving them isn't going to be all that useful. So if we're going to say, revenue is going to increase by 20% year over year, we need to back that up with either historically that's how we've grown each year, or the industry continues to grow that way and we expect us to do the same, or things like that. So we want to build an assumption really for each kind of line item in the forecast. Now we can combine some expenses that have similar characteristics or things like that and make kind of a more global assumption there. But those assumptions have to make sense, right? If we're planning on growing, and part of our growing is we have to hire employees, well, we better have assumptions in our salaries expense that account for that. It has to be kind of consistent, or if we know our cost of goods sold is, really typically 18% of our sales, that better be the same going forward. If it drops off to 12%, then we have to say, well, why is that? Why do we now have this? Why have our margins done better? And there better be reasons behind that. So that is a critical part of what a forecast is. And without those assumptions, we're really now just taking guesses in the dark. And typically what we do with our clients with the assumptions piece is just create a Word document and write all those out and have citations approved for where we got some of this information, so that the reader or user of this, if we're needing that from a third party, knows why we came up with that number. If they understand what we came up with that number, or that growth percentage or anything like that, and that makes sense and it is grounded in data, the more they're going to be willing to accept our forecast. And if our assumptions are just random guesses or things like that, the less they're going to be willing to do that. And particularly if we're running a business too, we don't have assumptions that make sense. So if we're using this forecast for a business, the assumptions we have actually have to be reasonable. And if they're not reasonable or don't make sense to our business, then again, our forecast isn't going to be really useful to us. So I'm going to give an example here from a fictional company called Drone Logistics. So Drone Logistics is actually a side note here. I teach at Northwestern University, and we do class that I do a class there with another CPA, and it's basically an entrepreneurship and accounting class. And really, we're trying to teach those students about as they start up a company, the things they need to know. And in our forecast example, we have this fake company we created called Drone Logistics, and we have them make a forecast and describe their assumptions and things like that. So I'm going to show just an example of what this is. And the reason why I like this is it's fairly simple. There is a few tabs, and we can even simplify it further down than that. But it's a fairly simple forecast, but it again provides us the data and information we need here. So let me switch this over here. So if you see here, this is our income statement forecast for this period of time. We built different assumptions in there about what our legal fees are. We gave them kind of some detailed notes of what all that is, and then they built this into a forecast. So really what we're looking for here in this forecast is a net operating income, or EBITDA. So EBITDA, as you see down here, is earnings before interest, taxes, depreciation, and amortization. This is really kind of the core operations of the business. So right here, we're looking at and saying, all right, here's our expenses from when we started. We're giving a little bit of a projected cash on hand here below to allow us to see, okay, are we going to run into issues where we run out of cash? So for example here, in September of 2016 here, based on our assumptions that we've put in place, we're going to run out of cash. That becomes a problem. And we have to be able to rectify that with getting finance and investing or things like that. But it's a way for us now, as we plotted all this out, to see, oh boy, our runway on our company is really short. And so we need to do something about that. Otherwise, we're going to continue to burn cash and not have the cash we need to run the business. So in this case, they projected out here basically a year and 3 quarters through the end of 2017 to kind of see where they end up based on these assumptions, based on not having sales start for March. So this is, again, a very simple, basic forecast. But we're laying out, okay, here's the money we have coming in, here's all of our expenses, and where does that get us to? And based on this, as this forecast, if I was drone logistics, I would want to know here and see, okay, well, based on this, we need to do something either to reduce our expenses or to bring in additional financing or investors. Otherwise, if we don't do that by September, we're done. So this is a case of a startup where they have serious cash concerns right off the bat here, and we need to do something about that. This tells us here that by September we're going to run out of cash versus us not having this in place and just doing business as is, and then it comes time to do payroll in September, like, oh, we can't pay our employees, and then that becomes a huge problem. The moment we can't pay employees or pay our debts or anything like that, then our business is kaput. So just, again, a very simple forecast that gets us to kind of see, okay, where are we going to be at here, from day one, through the end of the year. And what we tell our students when we do this is to say, all right, now that you know this, what should we do to change our business now? Now we have this expectation of where things are going to go. What should we do? What should we change? And so a lot of them say, okay, we got to get money and financing them, but furthermore, we really have high payroll costs. We need to reduce that. The owners shouldn't be taking a huge payroll. And it's a way for us to make now actionable decisions based on this data. So this is a really simple forecast. Again, that's kind of why I like it. It's simple and straightforward. Now, I've seen forecasts that have 20 different tabs and macros built in and stuff, and really that gets too complicated. If you don't understand where everything's going and how everything's linked, it's not going to be super useful to you as you continue to update it. Ultimately, that's what we need this to be. It needs to be useful to the business. And even if you're a bank or an investor, having some of that complex isn't useful for them either. They want to quick look and see what's going on. And having this, super complicated spreadsheet with all these different tabs and different calculations in there, it becomes quite complex, and it doesn't give them what they need as well. So this is a quick example here of what a forecast is. And if like I said, if I'm trying to understand this, I can kind of see, okay, well, we're really, we're burning a lot of cash here. We're expecting our sales aren't going to start for a while, and so we need to do something to get us to that point where we can start bringing money in through operations. So this is more of a going concern business. Let's get back in here to the presentation. All right, so we want to make forecasting simple. And so these next couple of slides kind of talk through, how we think about forecasting and how we do forecasting for our clients, and how we try to simplify that process. The more simplified and streamlined, straightforward this is, the more willing the user is to continue to use this forecast, and the more useful it will be to the business. So let's talk through some of these things and make it simple. Again, like I said, avoid complicated Excel spreadsheets. You can find a lot of them out there. If you Google, example forecast spreadsheet, there are ones out there that are super complex and super over the top. And again, we don't need this to be over the top. We need this to give us information, to provide us what we need to run our business. And so the more complicated it is, the more prone to errors we're going to run into, and the more issues that we have. And really, this makes it really hard to follow for the end users. The forecast needs to provide value, and added complexity isn't necessarily going to provide the value that we want from that. And we need this to be usable. The other thing is clear documenting assumptions. Like I said before, assumptions really drive a forecast, and so we need to have those assumptions documented and need to be clear. We don't have to go into super complex data about why our postage and delivery expenses are the way they are. We just need to know, okay, well, we typically spend $100 on postage and delivery each month. We expect that to continue, and we don't really see a reason why that would increase or decrease. So we're going to assume that our postage and delivery is going to be $100 each month for the foreseeable future. Simple, straightforward, explains what the number is and where we got it from. Or if it is, a revenue assumption based on market data, we want to say, all right, we expect our brewery to increase revenues by 24%. And if we look at the data provided by the Brewers Association for the last 3 years, the average growth rate for our size microbrewery was 24%. And so we're going to use that number because we feel pretty confident that that's going to continue. And we have the data and industry information to back that up. And so we're really trying to ground those assumptions, and we're making it clear. We don't need this to be super long or super in detail. It just needs to be clear of why we expect what's happening and have that based in something. It needs to be grounded in available data. And if we're doing different scenarios, let's have different assumptions too. So if our first scenario is without a loan, and our second scenario is with a loan, right? Let's add the additional assumptions we have now that we have this loan. What is that going to do for us? Or if you have a scenario that's, you're looking at, we expect revenue to increase by 10% in one scenario and revenue to be the same as it is now, or revenue increase by 10%. Explain why we are using those different scenarios and assumptions for that, and explain that we want to have that kind of best case, worst case scenario. And we don't expect this to do much better than 10% growth. And for reasons that we explain, we don't expect us to do worse than 10%. But that's kind of our margin, our range of possibilities. And so explain that and show why we're doing those different assumptions. Especially make sure we're tying variable cost to what causes them to vary. So for instance, variable costs may be utilities, and the more if you're a brewery, the more activity that you have, the more your utilities costs are. The more you brew, the more water you're going to consume. So we need to make sure that ties. And so if we say utilities are going to be $300 a month because that's what it always is, but we're expecting growth, it doesn't make sense that $300 a month will continue. I expect that to grow in line with our growth in sales, or to be tied in some way to that. Or if we have a business that is pretty seasonable, and we're going to, our salaries and wages costs are going to increase in those seasons, it better show up that way. Otherwise, it doesn't make sense how we do that. And again, assumptions always come first. Don't build your forecasting model and get it the way you want and then back into your assumptions. Start with those assumptions first, see what the forecast gets you. And if you don't like that answer, you have to figure out, okay, well, what needs to change? The forecast may not always be pretty, but it should give us information we need to change and grow our business. So don't overextend your forecast. I really, past 3 years, you start to really get into unknown territory. Even at that 3-year mark, you're making some pretty strong guesses that are less based on assumptions. So don't overextend your forecast. I've seen some forecasts that are projecting 10 years in the future, and past 3 years, a lot of those are going to be, that data is going to be really useful to you. Really, I like to see like a 1-year forecast, especially trying to simplify this, because that is, data is closer to you, and it's going to be more accurate as far as the forecasting goes. And then also with that, the forecast should be rolling as well. So after, we do a 12-month forecast and we now have a year, we've now got a month in where we have the actuals, let's add another month to that forecast. Now, based on this information, again, it continually evolves throughout this. So we want to make sure that, our forecast is evolving too. If we go a 12-month forecast and don't continue to extend months onto that, after 12 months, now we don't forecast anymore. So it should be a continual exercise to say, all right, now we've closed out this month. We want to see what that variance is with our actuals. But then we also want to add now a new month to our forecast. So we have this continual roll in 12 months. I love this quote here from Warren Buffett. It's better to be approximately right than precisely wrong. And one big error I see in a lot of forecasts is they try to be uber precise with their calculations. It really does not matter if you throw in that your growth rate's going to be 6.8%. That doesn't really mean all that much. If it's 6% or 7%, there's not a big difference there. If it's 6% or 16%, that's a big difference. But we want to be approximately right rather than precisely wrong. So if we try to really fine-tune our assumptions and our calculations to say, I expect our salaries to increase by 1.645% each month, well, that's going to give us a precisely wrong answer. We need to be approximately right. Again, we're not going to be perfect as we look at our actual activity versus what we expected. There's going to be some variances, and we're going to learn from those variances. But if we try to get way too precise with our projections, we're really going to be precisely wrong. So again, it's better to be approximately right than precisely wrong when we look at projections. And this needs to be usable and user-friendly. So again, if we have a spreadsheet or something that has got a lot of different calculations and things, and the user doesn't know how our inputs are getting to our outputs, it's not going to be as useful. If like I said, I really like a single spreadsheet presentation because it's user-friendly. We can look at it and see what's going on, and we're not flipping between a bunch of different tabs or things to see what's actually happening. So we really want to make this usable and user-friendly as well. So our forecast should include both EBITDA and cash flow. So EBITDA is effectively our net operating income, and like we showed on the spreadsheet, it is our earnings before interest, taxes, depreciation, and amortization. So depreciation and amortization are non-cash items. We've already spent that money in the past. So we bought some equipment or things like that. That was money spent in the past. And the depreciation and amortization accounting that we do for it isn't going to impact our bottom line. That's already been done. And that depreciation and amortization is great for tax purposes and for financial statement presentation purposes, but for forecasting purposes, doesn't provide us a whole lot of that. With interest, typically that's associated with some sort of loan. And really, we're going to care a little bit more about the overall cash flow, the interest and the principal, versus just the interest alone. And then with taxes, again, depending on what type of legal organization we have, whether we're a C Corp and we're paying taxes at the corporate level, or we're an LLC or an S Corp and we're paying this at the investor level or member level, again, that's not going to have a direct impact on that. We really want to see what that net operating income is, because that tells us how the business itself is operating. Some of these other things that are non-operating things aren't, really, driving the business as a whole. So the way we like to do forecasts is show what our EBITDA is, or net operating income is, and then other cash flow items. So loan repayment, both the principal and interest side of it. If we're buying fixed assets from operations, we want to show that. If we want to show loan income coming in. We want to show that stuff, or other cash items that isn't being picked up in our net operating income. Ultimately, this gives us that role in future cash flow balances, and lets us see, do we have issues where we're running low in cash, or do we know now that, hey, maybe we don't need that loan? If we wait 6 months, we're going to have the money from operations to buy what we need to buy. That allows us better information. Again, we want to update this forecast periodically. Ideally, monthly is a good time for that. Quarterly is okay too. I wouldn't want to go less than quarterly. If we were really, really, really into this, we could do it weekly, but I don't know how much value it provides. I think monthly is a pretty good time frame for that, especially as part of that accounting process where we're closing out the books for the month and making sure everything's set and looking good there. Now that we have those closed, that closed books, we can use that information to help us update that forecast. And I think that's a good timeline for that. And again, simple one-page Excel, or if we're adventurous enough, we can use a forecasting software. The one we use in our firm is called Futurely. It allows automation for the actuals and running variance analysis and KPIs and things like that. So we can do some more complex things if we so desire. But where I really like using that forecasting software, it allows us to easily see that the forecast versus actual. Whereas in the spreadsheet, I may have to input manually in my actuals and do my variance analysis that way. The Futurely kind of allows that a little bit more automation process. But again, we don't want to go. We could take Futurely and make it super complex, and we really don't want to do that. We want to make it straightforward. So these are kind of our tips for making forecasting simple. Ultimately, it needs to be usable to you, the user, in order to make proper business decisions. And if we can do that, then we can then make the decisions we need to make and have the data we need to make those decisions behind, and not feel like we are driving blindly. That we can see what's going on ahead of us as a company. We can see where we're going and have better confidence of what the future is going to hold for our business, and not relying on what's in our bank account balance, or what prior profit and loss statement showed us. We really want to see how the business does as a whole. So with that, I will open up for questions. Feel free to drop those in the chat box. Anything that you have questions on forecasting, or things we can talk further, we'll be happy to do that. And yeah, feel free to use the chat box, and we'll stick around here for a minute or two to see if you guys have any questions, or if there's other things you want to talk about further. Again, you can reach me at josh@lancecpa.com, or visit our website, or you can find us on social media as well. So we'll leave it open here for a minute or two to see what questions you have and answer those for you. I'll give it here just one more minute. So again, any questions you have, feel free to shoot those in the chat box, and we will see those. All right, if we don't have any other questions, I don't see any questions come through here. It was great talking with you today. Again, anything, after you're done viewing this and something pops in the mind, feel free to reach out to me, josh@lancecpa.com. You can hit us on Twitter at Lance CPA Group, also on Facebook at Lance CPA Group. Or again, email us at josh@lancecpa.com, and we'd be happy to answer those questions. Again, thanks for joining us here today for our Forecasting Made Simple webinar. We will talk